What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Hey everyone, welcome back to The Last Trade. This week we have Gary Brode of Deep Knowledge Investing joining us once again. It's been about 7 months, Gary, since you were on last, so I'm sure there'll be a lot to talk about. And of course, we have Michael Tanguma and Jesse Myers, my co-hosts here. Gary, how are you doing today?
Good. Thanks for having me back. It's good to see you guys.
Yeah, it's good to see you as well. Last time you were on the show, Marty Bent was the host, so we'll try to keep the same flair that Marty had, and it'll be a dynamic conversation as always. So appreciate you making the time, carving it out to speak with us again.
Yeah, I'm a huge fan of the work you guys are doing, and really, Marty and I got to communicate a little bit on X yesterday. I think we're going to talk about it later, but I think his interview with Caitlin Long earlier this week was phenomenal.
Totally was, yeah. We'll definitely cover that. I had the chance to catch up on it this morning while I was sitting in some Philadelphia traffic, so definitely will be keen to share some thoughts there. But Gary, maybe we can start with big headline of last week with the 50 bips rate cut. You categorize it as bigly, a term coined by Donald Trump, maybe incorrectly, but nonetheless, it was maybe a shock for some people. Others were expecting it. But Gary, would love to hear your thoughts and what you decipher in the markets and the economy, and what does that 50 bips rate cut tell us about where it is today and maybe what we should expect going forward.
So I think there are a couple of interesting things going on. First of all, I'm in the minority on that rate cut. I actually think the Fed cut too soon. I do believe there's a huge slowing of the economy. People say we're in recession, and I'll get to those thoughts. I think they're totally valid, but inflation is still elevated. I think the CPI is understated, so actual inflation is worse than what's being reported. And the government, this is the most important thing, Congress, both parties, are still spraying trillions of dollars of value-crushing stimulus into the economy that's pushing out the private market economy. So I think with all of that, the Fed should have tried to get Congress to move. I don't think it would have been effective, but they should have held the line longer. With that said, they decided to cut, and they did the bigger 50 basis point cut rather than the smaller 25 basis point cut. And I think the reason for that is because Powell and the Fed have realized something that Deep Knowledge Investing and I have been talking about for the last year, which is we have a bifurcated economy. So when we look at the aggregate data, when we look at the GDP numbers, and even though the recent employment numbers have been weaker, we still have growing employment. And that's even after all of the adjustments down. We still have almost 8 million jobs listed. Not all of them are real, but the point is the aggregate numbers for the economy look really good. And the reason for that, again, is because government spending, even if it destroys value, adds to GDP. And so Congress is basically creating the GDP number that they want to run for re-election on. And again, it's a bipartisan problem. So, the reality is that that's created an economy that is fantastic for people who are beneficiaries of government largesse and people who are very wealthy and can take on debt and buy hard assets and benefit from inflation. That leaves most of the rest of the country with a very weak, faltering economy. You see the shipping rates coming down. You see lower demand. A lot of the manufacturing numbers haven't been good. And every time I talk to people who are running small businesses, they are just suffering in this economy. And so, I think what we have are aggregate numbers that betray reality. And I think the Fed realized that and said, hey, the actual numbers look good, but we have a lot of people who aren't doing well, and they're looking to try to provide relief. I don't know that 50 basis point cut is going to be effective in doing that, but that was the instrument that they had.
At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession, and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Yeah, that's interesting, Gary. And I was a bit surprised to read that you thought that the Federal Reserve was early to cut rates. Not that I disagree with you, but I think it's maybe a minority opinion at this point, because there are people that were calling for the Fed to cut, 12 months ago, maybe longer, right? So I'd be curious to hear. That was a great overview. I'd be curious to hear your thoughts just as it relates to inflation. Then inflation is obviously still persisting. It's in absolute terms, everything that you'd want to purchase is much higher than it was 4 or 5 years ago. And we understand that CPI is a handcrafted or selected government metric, and it's also year over year, right? So just because the CPI print is coming down, it doesn't mean that the prices in the economy are returning to levels that we saw 5 years ago. So I'm curious where you think inflation's at. You also put together a great chart. I'll pull that up too, just for some historical perspective, because I think that'll paint a nice picture going forward.
Yeah, so I think the point that you made is it's a crucial point, which is people are frequently misunderstanding the difference between deflation and disinflation. And so disinflation, for all of you calculus nerds who loved high school math, it's a second derivative. It means a slowing in the rate of increase. So if you have, an inflation rate of 9% that goes to 6%, that's disinflation, but prices are still rising. If that 6% goes to 3% or 2.5%, which is where they're telling us it is now, you still have prices rising. And the issue is that we've had years of elevated inflation that raised the price index for people to the point where a lot of people are having a very hard time paying for their basics, paying for their rent or mortgage, for a car, to put gas in the car, and to buy groceries. And those necessities are taking up a huge portion of people's budgets. And, the government and these economists and the Federal Reserve and all of these Keynesians and MMT fans are busy celebrating, hey, we got inflation down, we won the war. And most of the rest of the country is saying, wait a minute, my groceries are unaffordable and the prices are still going up. And, the government economists are saying, but they're going up more slowly. And that's not helping. Regarding, where I think inflation is, the hard thing about that is people's inflation rates vary wildly. So for example, in my case, I do this for a living and I saw this coming and I refinanced my mortgage in the fourth quarter of 2021. You could see inflation coming. You knew rates were going to be coming. I locked in that mortgage rate for the next 30 years. So I was in a good position. But what if you changed jobs or you moved and you had to refinance your mortgage? All of a sudden, buying a new home in that market and having to finance a mortgage at rates that were twice as high, what's your personal inflation rate, right? And so it really depends. If you owned good cars or cars in good condition going into 2022, you were in good shape. If you had to buy a new car to get to work, all of a sudden those prices went up. So, I think there are a couple of places to point to inaccuracies. The most obvious one is the shelter or housing price, where they're using OER. It stands for owner's equivalent rent. We have charts on that, which I'm happy to send you. But owner's equivalent rent, which is what's used in the consumer price index, it just constantly understates the actual prices when you look at like a Case-Shiller index or the Zori, that's the Zillow index. Another place where I think there's inaccuracy is in food pricing. I continue to state that anybody who believes food inflation is only 1 or 2% hasn't been in a supermarket in years. And, nobody ever disputes me. Every time I'm on one of these shows, I tell people, if your grocery bills are up only 1 or 2% in the last year, email me. I want to see it. You'd be the first person to do that. Regarding, where people thought we were, you're right. It's not only that people thought that the Fed should cut a year ago. I've got records. We were talking about this as early as May, June, July of 2022. This has been going on for 9 quarters where prominent people were screaming for the Fed to cut rates, even as inflation was at insane highs, right? I mean, approaching double digits, they were saying the Fed should cut. And my response to that is those weren't people who understand the economy and had the best interest of the American people at heart. Those are people who were asset gatherers and really liked collecting fees on bubble prices, right? And they still got that, right? The market continued to go up after, the midpoint of 2022, despite the fact that the Fed ran a tighter policy, and everybody's screaming, the Fed is, they're too tight. They're running us into a recession. But in the meantime, what happened to asset prices? Housing prices, gold prices, stock prices, right? The price of assets continue to rise and are in bubble territory right now and unaffordable for a lot of people. So, I think there were a lot of people calling for the Fed to cut as much as 9 quarters ago. And, I continue to maintain that I believe they were wrong, and they're entitled to their opinion. But, I want you guys to think about what the impact of inflation would have been had the Fed started cutting rates, more than 2 years ago.
Yeah, I mean, it's scary. The grocery store is the most visceral or like tangible because you just like look around, you're like, how is anybody making it? Especially if you're not the dominant shopper in the household, but you go every 6 weeks or 2 months, you kind of get it like a shock. You don't see it every week gradually. That's kind of like how I end up seeing it. I'm like, wow. But what's scary is like, I don't see how like if they raise rates, I could see how inflation in a lot of the key sectors would actually increase as well, with the notion of destroying productivity by businesses going out, just like the demand. There's a lot of things that have been baking into it. I think the energy sector was one of them. As you increase rates, you can actually also increase inflation based on the aggregate production going down while the demand still staying static. And so it's just like there's no way out of this. It's like we just have persistent inflation no matter what, and then maybe the lever on the margins increases it on certain sectors more or less. But there's not a lot of outs in this economy for somebody to basically make a living in the traditional way of making a living, storing it in dollars and hoping to get anywhere outside of moving backwards, which is pretty scary for the average person.
I agree with you. And in fact, about a year ago, Deep Knowledge Investing put out an ebook called Counterintuitive Inflation, where I argued with, I think, something like 17 charts, that no matter what the Federal Reserve did, we were going to get more inflation. That if they started to reduce rates, you get inflation. And Michael, I think your points are great points. I took a slightly different approach than you did, which is to say that our debt is so high that if the Federal Reserve had increased rates, what we end up with is higher interest expense. And with our government spending trillions of dollars more than it's taking in taxes, I refuse to call it revenue, it's taxes, that what you would have is an increase in interest expense that could only be paid for by printing more dollars, increasing the supply of dollars. That leads to inflation. If that sounds like a Ponzi scheme, congratulations. That is the definition of a Ponzi scheme. That's where we are. This is why I'm saying I don't think it matters so much what the Federal Reserve does. The only thing that matters right now is the debt and congressional overspending. And, credit to Lynn Alden on this. She's been writing basically the same thesis on this. And, Lynn's writing, I think, is brilliant. Her reasoning and research are terrific. The term she uses for it is fiscal dominance, which is a great term. But it's basically just another way of saying the government has taken on so much debt and is overspending by so much that no matter what the Federal Reserve does, that's the small lever. The large lever is congressional overspending. And that's basically where we are right now. I also, Michael, think the point that you just made really bears repeating. And for your audience, you cannot save in dollars, right? The things, and I'm a little older than you guys are, but the things that we were told when I was a kid, the things that my parents were told is, spend less than you earn and save the difference. And that's not bad advice. It's actually great advice. The problem is you can no longer save in dollars, right? The dollar debasement is in full swing here. Again, the dollar is now a total Ponzi scheme. And so, I can't tell you where, the dollar index is going to be next year. But one of the things that I like to do is ask people to reframe the way they think about inflation. So the original definition of inflation was an increase in the money supply. And then that shifted to an increase in prices. And the way I like to frame it for people is I want you to think about inflation as a reduction in the purchasing power of the dollars you hold. So if you have $1,000 in your bank account today, you could go out and buy a certain amount of goods and services. So really easy quiz here. Imagine you have that same $1,000 in your bank account. How much in terms of goods and services do you think you could buy in 1 year, 3 years, 5 years, 10 years? And you guys know the answer, right? It's less, right? So that $1,000 is not going to hold up. And somebody could say, oh, but you'll earn interest on it. Yeah, but not more than the inflation rate. They've figured that part out.
Yeah, it's fascinating. It's a loaded question, but what are the implications then, Gary, of the U.S. Treasury assets no longer being an asset for savers, right? It's now a liability to store your wealth in dollars directly or in government bonds and bills. And how, it's such a big idea, right? Because I like to think, taking a generational view, I know for a fact that my grandparents predominantly saved, Great Depression, right? If that's your center of influence, you're more likely than not going to touch equity markets because you lived through the Great Depression. So you save in bills and bonds, and those are kind of the safe haven, the conservative way to preserve your value. Over time, as the market structure evolves, we have got the S&P 500 as the de facto savings account. And if you were to ask someone 100 years ago, would you predominantly save your money in equities? The answer would likely be no. And now we're, I think, transitioning into a world where Bitcoin plays a significant role, of course, but that doesn't mean that equities and real estate still don't play a role in preserving wealth. But there are, in my opinion, pretty big implications that storing your wealth in bonds and obligations of the U.S. government will mathematically pay back a negative real return. So what are your thoughts on that? I mean, it's a big idea and big question, but I think this is a theme that we're going to see play out not just a year from now or 5 years from now, but for decades.
I completely agree with you. And what's really interesting is I've read these fascinating psychological studies of the saving practices of people who lived through the Great Depression. And it's incredible. It affected them their entire lives, right? I read this story recently about, somebody who lived through the Great Depression, and she lived to a very old age, but when she died, her kids found hundreds of pie tins, those aluminum pie tins, because it had value during the war. And, to us, it sounds crazy to save thousands of those things, but these formative events, these traumas that people experience, they do make an impact on our psyche, on our emotions. And, while I try to keep emotions out of my trading and investing as much as possible, we're human beings, and this is really normal. They're formative events. But the thing I will point out is, if we're going to go back in history, let's point out how people who tried to save in dollars were harmed. And it's not just the fact that inflation took off since the creation of the Federal Reserve, just, a little under 2 decades before that 1929 great crash. Remember that, it was only a short time after that 1929 crash that FDR changed the amount of gold that you could buy with the dollar. The dollar got devalued overnight. He confiscated everybody's gold and then changed the price of gold. And the converse of that is, when you change the price of gold, you change the price of the dollar. You change how many ounces of gold you can buy with a dollar, And so that's a big deal. And then in 1971, President Nixon took us off the gold standard. All of a sudden, the dollar went from backed by gold to backed by faith and credit. And, I think faith is a perfectly fine thing if you're in a religious institution. I think, faith in your fellow man is a great thing. Having faith in the government is foolish. There's my political opinion for the day, And so these things keep getting revalued. And it's never going to go for you. And worth pointing out, the reason Nixon had to take the U.S. off the gold standard was because we had printed more dollars than we had gold. Again, this overspending problem, it's not a recent thing. And it's not a Republican thing or a Democratic thing. It has been a bipartisan problem for more than half a century. Right? I mean, at this point, it's just endemic. Let's talk about practical solutions, though, because we shouldn't be all doom and gloom. Right? There are answers. First of all, and this is not a good thing, but unfortunately for a large part of the American public, saving in dollars, what they save in, it doesn't matter. They're not saving. Right? We've all seen the statistics that some huge percentage of people, they don't have $400 in case of a medical emergency. So a huge percentage of our country, every dollar that comes in, they're spending it that month. There are no savings, not effectively. So they're not saving it at all. And that's unfortunate. And if you are one of those people, I understand. I get that things are really hard. I get that everything's becoming more expensive. I would advise you do what you can to try to live beneath your means. That's the case whether you're poor, middle class, or wealthy. It's just good advice. And I understand for some people that's going to be impossible, but work towards it. It will give you more financial freedom. For the rest of us, I think you're 100% right. We can't save in dollars. The treasuries are no better because you're going to be repaid in debased dollars down the road. Think about the other side of my mortgage, right? I'm going to be making the same mortgage payment in 30 years. Well, what's the value? The check is going to be the same, but what's the value of that check? What will that check buy the people who own, my credit then? Well, trust me, the government is less responsible with their money, or rather our money, than I am with mine. I'm a better credit bet than the government is. So, what do you do? And you brought up some options. You can save in gold. You can save in Bitcoin. You can save in energy. I had lunch last year with a friend of mine who's a really smart portfolio manager. And he said, if I could save in anything, if I could save my wealth in just one thing, he said, I would want my wealth to be measured in barrels of oil. It wasn't a bad assessment. And, he's well aware that gold, silver, Bitcoin exists. That for him was a decision. If you can afford it, high growth stocks is a great place to start to save. And anything hard assets, anything that the government can't print more of is a pretty good place to hide and try to start to accumulate wealth.
But Gary, what about T-bills? They're paying 4%, and it's risk free.
It's funny you say that, Jesse. I heard there was a Safe had Preston on his pod, and it's a really great pod. But they reference this one keynote was like the killer app for crypto was demand for dollars. Because when you think about like crypto coupled with like stable coins, it's just you created this like $1 trillion plus asset class for more bonds. Gary, just going back to you put this in light of like currently what's happening and where we're feeling it on a micro scale. I feel like the past 6 to 8 months have been really transformative, or like a real inflection point for gold because of gold's breakout. That I think people talk about and know it's happening, but I think it's the ramifications are so much more than what's discussed. Simply because gold's all-time high had sat around that like $1,700 a troy ounce for a very long time, and this move to like close, I think we're almost at 2,700. Is not only the micro scale understanding that treasuries and dollars are no good, but this is like a more macro geopolitical undertaking of movement of assets into gold. And just curious like how you think about that and what that signals today and then like moving into the future.
I think it's fascinating, right? And gold bugs, they had to sit on their hands for years and years and years as the price of gold didn't move. It is a large position for me. I've owned gold the last few years. It's done really well. I think there are two things going on there. One is what you talked about. The geopolitical aspect of it matters. And there are huge debates on Twitter or X now about, the dollar as the world's reserve currency and people talking about competition for it. And, they're really interesting debates. But the one thing that's not up for debate is that while the U.S. remains, the dollar remains the global reserve currency right now and will be again next year and the year after, it has been losing share for a long time. And what we're seeing are foreign governments realizing, wait a minute, Congress is debasing the dollar. We don't want to hold that. And they also saw our disastrous sanctions against Russia. And, it's not that I'm against sanctioning Russia. It's that I've argued that the design of the sanctions were poorly done. And confiscating their assets, it felt good. It seemed like a good idea, but it didn't stop the Russian war machine. And what it did was it sent a signal to the rest of the world that we are an unreliable partner. That if you want to hold dollars, you need to remain in the good graces of Washington, which would be fine if Washington had a coherent policy. But as you guys know, right, the people making policy in Washington change every 2 to 4 to 6 years. So how do you do that? How do you do that when the president changes every 4 to 8 years and control of Congress regularly changes within a presidential administration? How do you remain in the good graces of a country that doesn't have a consistent foreign policy? It's not possible. And so countries like China and India are saying, you know what? We want to own more gold. And they're importing huge amounts of gold. And gold is flowing from west to east. And, historically, empires have been built on that. Historically, world reserve currencies have been backed by whoever had the most gold. Now, do I think, that China and India are going to have the world's reserve currency in the next few years? Absolutely not. But this is not a good trend for us. And it does show that foreign governments have a lack of trust in the dollar. And, right or wrong, I understand the reasons. These are not irrational people. We may disagree with some of their policies, but they're not irrational. And that's something that, we should be concerned about. The other thing I'd point out is sometimes I find it useful to look at things backwards, which I know sounds crazy, but, I'll give you guys a great example. People love to talk about the price of gold going up. And when they say that, they almost always hear in our discussions mean the dollar price of gold going up. I mean, you talked about gold going from 1,700 an ounce to 2,700 an ounce. And that's a huge move, right? So I've made money in my gold position. I could trade my gold position today for more dollars than it cost me to accumulate that. Well, here's, I think, maybe a better way to think about it. It's for thousands of years, the value of gold has remained relatively stable. It's the value of fiat currency that continues to decline. What we're seeing is not an increase in the value of gold. What we're seeing is gold maintaining its purchasing power while the value of the dollar, the purchasing power of the dollar, slides.
Yeah, that's a good point, and it's always a good reminder to measure a commodity like gold or oil or Bitcoin in the denominator is changing, right? And people don't necessarily go to the first principles to understand that. I'm curious, Gary, so obviously debasement plays a big role in the demand for gold and other scarce assets. But what do you think has gold outperforming virtually every other asset class? I think besides Bitcoin this year, I want to say gold is up maybe 25% or so year to date. Was it a combination of the geopolitical situation we find ourselves in? Is it, in addition to that, gold sniffing out and knowing that there was going to be easing from the Federal Reserve and other global central banks? Is it just the fact that there are more dollars that exist now? The money supply grew by 40% or so in a matter of 18 months. How do you kind of attribute the performance of gold in dollar value to these different factors that seem to be driving the price?
I think there are two crucial elements to that. One is there's this flight to safety. We are at a point where we have an enormous amount of geopolitical risk. And, again, I'm a little older than you guys, but when I was in elementary school, we would have nuclear bomb drills. We were worried that the Soviet Union was going to destroy us all with nuclear weapons. And in these drills, we would hide under our desks. It's not clear to me if we were hit by the windows, the glass from the windows might not have hit us, but, I don't know that hiding under your desk is going to save you from a nuclear blast. But, this was the drama that we engaged in. And then we had a period of relative calm, but now, look at what we have. right now, the U.S. and Russia are involved in a proxy war. But, in the past, we avoided direct conflict, right? I mean, first it was the Soviets in Afghanistan and the U.S. supporting them. Sorry, before that, it was in Vietnam. That was a proxy war. And then the Soviets in Afghanistan was a proxy war. And then the U.S. in Afghanistan was a proxy war. And we've done this many times. But with what's going on between Russia and Ukraine right now, this is going dangerously close to moving from a proxy war to direct conflict. And, people in Washington seem to be very willing to risk World War III. In some cases, it seems like they're trying to advocate for it. And, listen, I think that the Ukrainians should be free to chart their own course and not be invaded? Yeah, of course I do. But that, there are ways to get there without getting us into World War III. We have conflict in the Middle East. We have sovereign debt crises all over the world, not just in the U.S. And we talk a lot about U.S. debt, but this is a crisis all over the world. You have immigration that on one side is being referred to as migration, on other sides is being referred to as colonization, but it's completely changing, people's lives. There's a lot going on. And I think in a situation where people are realizing that the dollar, which is the best house in a bad block, is a Ponzi scheme, there's this huge flight to safety. And gold has been that for thousands of years. Do I think Bitcoin will be that? Yeah, I do. But with Bitcoin, I think it's important to separate the short term and the long term. In the short term, Bitcoin trades as a high beta proxy for mega cap tech stocks, right? It's basically that this is a fancy way of saying you're basically buying a leveraged version of the NASDAQ, right? Of the QQQ. And that's pretty much how it trades. And on days when, the NASDAQ trades up 1 or 2%, you see Bitcoin trading up 3, 4, 5%, and then the opposite. So that's where we are short term. Long term, I think Bitcoin will be an excellent inflation hedge because Bitcoin is now harder than gold and the dollar is just being printed into oblivion. So, when people say, well, Bitcoin hasn't acted as a hedge, against dollar debasement, my response is, in what time frame, right? If you're looking at it, like people post these things on X on a daily basis, Bitcoin's down 5% today. See, it's not an inflation hedge. Okay. But what about over the last year or the last 5 years or the last 10 years? Or more importantly, the next 5 years or the next 10 years, right? That people, it's one of the great ways that we engage in sleight of hand is by changing the time frame that we display to people. And, look, I'm guilty of it too. Every week we produce a piece called The 5 Things. Each one of the things has an image. You think I don't pick the period I want to show in the charts? We all do it, right? I'm not poking at anybody else. Of course, we choose the time frame that makes our argument. But if you take a step back, Bitcoin has been a great way to hedge against loss of value of the dollar. And I think that will be the case. But in the short term, if you want to hedge against global unrest, in the short term, gold is your option. In the long term, I think you make more money in Bitcoin.
Yeah, you said like looking backwards, and it's such a great framing of like gold's opportunity or hedge, and then Bitcoin's opportunity, because you reference it's like the old notion of what is it? A troy ounce can buy you a cow and a nice suit, or that
Yeah.
that idea is like, so gold keeps pace with inflation or hedges against inflation, where Bitcoin does that, but it's also still in its monetization period phase. And so you get the upside, you get the hedge coupled with the upside, and the volatility is the opportunity that you just have to be able to manage, because that's what keeps everybody out, is the volatility. But the volatility is your friend if you, to your point, size it appropriately. That's just an interesting, it's an interesting dynamic of, you mentioned gold, energy, stocks, and oil. Because like oil, the derivative of oil is like how much gold can you buy with barrels of oil, and how much Bitcoin can you buy with barrels of oil. Right. And ultimately, Bitcoin's the one that, it's paced over a long enough time. It's just more portable than the oil. It's almost like it is oil. It's in a different form factor.
Yeah, well, I think one of the best descriptions I heard of Bitcoin is it's stored energy,
Yep.
which I thought was a fascinating way to frame it. Also worth pointing out, you're right, Michael. Like thinking in terms of gold, like Michael Gayed talks about gold and lumber, and he's used that to figure out the direction of the economy and the stock market versus gold. And I think those are really interesting relationships. You're right. Like, gold to oil or Bitcoin to oil is a good one, but worth pointing out that oil is typically priced in dollars. And so, at some point we come back to a dollar that's just losing purchasing power. Also one of the questions you guys sent me, when we were preparing for this was, gold outperforming Bitcoin in the past 6 months, which is true. But I'm also going to point out that we don't have to go back that far. Year to date, I checked this just before we came on air, Bitcoin's up 55%. So, has Bitcoin hasn't done anything in the last 3 months. It's gone up and down a lot, but here we are sort of in the same range that we've been at for a while. It's been range bound for a bit, wide range, but so what, right? Like one of the things that I really love about a huge part of the Bitcoin community is this culture of, I don't care where it is today. We're just going to hold, right? It goes down, then we buy more, right? And and the amazing thing is, what I spend 90% of my time on are US equities, stocks. And you have no idea how many times, I tell somebody, listen, I think this company is undervalued. My thesis is over the next 3, 4, 5 years, this is what's going to happen. And 5 years from now, you end up with stock price of X. And okay, great. I like it. And then, the stock goes down a little bit and they call me a week later, like, why isn't it working? I don't know. I don't know. I don't know why the stock is down a few percent in the last week. I know I had a 5-year thesis on it, and there's no news in the last week that has invalidated what I think will happen over the next 5 years. And I would love to see, I think investors would be well served to take that Bitcoin sense of patience and longer time frame and ability to stomach short-term volatility. And if you were to take that into equity investing, there is a time arbitrage where you can take advantage of people's impatience and emotional volatility and buy when people are upset, and then just hold it through a longer period of time. And investing like that, I think you do really well.
Well, and that kind of ties into this podcast being called The Last Trade, because there's a Zen, and I don't know if you're there because I understand your background, but there's a Zen, I think most in the Bitcoin side, it's like, there's nothing else. So the Zen is that you're just holding money and there's nothing else to trade it. So you just hold it until you want something in the real world that's what you spend the money on. So it's short-term price appreciation. While it hurts because we're humans and there's a psychological component, it's not like, well, what's the next thing? Because that's generally where trades turn into. It's like, well, what's the next thing that I got to get out? I have to find my exit position. The other thing that's really amazing about Bitcoin that you kind of referenced to is it's really bleak for a lot of individuals that don't have an opportunity to get out of like the rat race that they're in. But this notion of like it has the capabilities of like a stock where you can download any application and buy 1 penny of it. If you can get out of a quarter, a dollar, whatever it is, you can get a taste of it in any country, in any place, which hasn't been affordable to most. You referenced the energy side. It's like, I don't even know how to go. Like, I mean, I'm sure I could Google it, but like, where would I get my energy exposure and what brokerage account do I have to sign up? And there's a lot of learning. And of course, volatility of Bitcoin is a learning curve, but it's a lot more accessible. And I think once we get it cleaner and easier, it's just going to be a step. Like, it's going to be a lot easier for people to just port over and start to move. And you talked about like simplifying things. I love the notion of Bitcoin is just like Bitcoin or the dollar. It's like, what's the value prop? It's like one lets me buy more eggs every week than the other, right? Like at the end of the day, like that's what this all nets out of. Is like you go to the grocery store and every other currency, specifically the dollar, because we're used to it, just buys you less goods. And then, generalizing, but over time, Bitcoin just lets you buy more food and provide, which I think is an easy thing for people to wrap their heads around once it becomes more ubiquitous.
I think it is too. And, look, Bitcoin is my largest position, not because I bought the most of it. It's because I bought a decent sized position and then it just keeps going up. So it's become a huge position. And then, I I remember a couple weeks ago, when Bitcoin was down temporarily, and it cracked 60,000. I think it hit 54, 53,000, something like that. And Michael Saylor tweeted out or posted on X, "You do not sell your Bitcoin." And somebody who, I forget who it was, very, very funny, responded to who I'm saying somebody is, right? And so I don't sell my Bitcoin, and so it's become a larger part of the portfolio. That said, and I get the appeal of the last trade to say, hey, you can just do one thing, and if you do this one thing, you're going to be fine. With that said, I don't love the idea of having all of my assets in one anything. And if you want to argue, but it is the highest upside position you own in your portfolio, I 100% agree. I have individual stocks in my portfolio that have the possibility, that have the potential to go up 10x. And, you guys will laugh because you're like, well, Bitcoin can go up a whole lot more than 10x. And I 100% agree. I just don't like having everything in one place. And I get that that's not necessarily in line with where you guys are and where some of your audience is. But, as somebody who's managed money, who's been an asset manager my whole life, I like at least some diversification. Also, Michael, I can solve your problem for you where you're saying, hey, if I wanted to invest in energy, I wouldn't know where to go. Deep Knowledge Investing, that's deepknowledgeinvesting.com. That like we do that. I maintain, there's a current recommendation portfolio. We have a huge energy portfolio where people are making a lot of money, and I like the stuff we own. And, energy is a big part of our portfolio, as is Bitcoin, but certainly not all of it. That and gold and, high growth, potential return stocks. And, that works for us. But, that's the answer to your question. That's where you go if you need help with that.
And on the point of, position sizing, I think we don't talk enough about the realities of this, of like, if you're Gen Z and you're just getting your first job and you don't have any savings, like what's the right position size for Bitcoin? In my opinion, it's 100%. Like you put your first $10,000 into Bitcoin, and just, start building that position. But, if you are the heir of someone who left you, someone who did very well in life and left you a fortune, the right position size for getting into Bitcoin is not 100%. It's very different. Your job is to defend that position, that position in life that your family bestowed on you, and pass it on to the next generation. So you're playing a defensive game inherently, and the right position size is, maybe it's 1%, maybe it's 20%, but it's probably not more than that. Just because your responsibility is to do something different with your finances than someone who's just starting out and just trying to build. And we as Bitcoin advocates, we don't acknowledge that enough. I think that it very much matters, your circumstances in life, and if you are closer to retirement than the start of your career, you probably are more in that more conservative bucket, or should be, because you don't want to lose sleep at night and wake up in cold sweats because you have too large of a Bitcoin position and you're betting your retirement ultimately on being right about Bitcoin. I think that's an easier place to get into if you start without much, build your Bitcoin position and grow your conviction along the way. But yeah, it's a different ballgame for most people out there.
I think that's exactly right. I will say, it is funny, and Gary, you probably know folks like this. I know Jesse and Jackson do, is like older individuals that get in, and this is like the bullish case for Bitcoin. People get very short. They feel very short Bitcoin when they come in and they have wealth. And I've seen people throw everything out, including the kitchen sink, to get rid of their real estate, their cars, their watches, to go buy Bitcoin. So it's an interesting dynamic on like the different, I think a lot of it has to do with like education and like looking at just the monetization that's happened around real estate as a good example. Like there's a lot of things that aren't organic there. But then Gary, on your side, I think we talked about it on one of the pods we did, because we've done two, where this notion that was like, I think we went back to like biblical times, but I know it was like a opinion where you have like a third, like in your land, in your money, and in your business. and it's just like randomly, like you naturally organically have kind of like fallen down that path as you get older. I think maybe to your point, like whether it's on purpose or just by default, you start to diversify from your holdings and you invest in, cash flow, nature things like a business, or you buy some land because it provides you other utility outside of an investment, that coupled with it. And then you end up in these positions that you're not as concentrated in a singular thing, which I think is what you're alluding to from a risk perspective.
I think you guys both make great points. As somebody who grew up in the hedge fund business, I'm constantly thinking about position size. Where do I have a ton of confidence? Where do I have a lot of upside? How big can I get in something? Other things where I'm really worried about the downside, you may take a 1% position or a 3% position, but you want to limit that risk. And so I grew up in this business thinking about that. And, Jesse, your point is crucial. Like, know where you are in your life, know what kind of risk you're taking. And when you talk about playing defense, it reminded me many years ago. I was flipping through a Forbes magazine, and it was a list of all the billionaires in the United States, or maybe in the world. I don't remember. Anyway, the thing that I thought was fascinating was more than 90% of the people on the list, and this is years ago, and so the people at the very, very top had something like 50 or 60 billion dollars in wealth. Now we have a number of people above $100 billion and one or two above $200 billion. But then the top of the list was in that 50, $60 billion range. But more than 90% of that list was grouped between 1 and 3 billion. And you could see the point where everyone's like, okay, great, I'm all set. I'm done now. Now I'm going to play defense. And they clearly had stopped trying to build wealth. And there's nothing wrong with that, right? You build yourself $1 billion fortune and you say, I want to take a break and not lose it, as opposed to grow that into 50 billion. Certainly I can understand why somebody would feel that way, but it's really interesting. You could see, numerically where everybody's just like, okay, I'm done. Right? I don't want to do this anymore. More importantly, let's talk about, were you saying put your first $10,000 into Bitcoin? That's a really interesting way to think about it. And, certainly having, a stock portfolio of $10,000 isn't a bad idea either. But maybe the easiest way, because you're right, it's not like you have to buy one share. I guess now you can buy fractional shares, but effectively it's hard to diversify a portfolio at really low levels. But, we were talking before about people who are really struggling. And, I was saying, try to live on less than what you make. But understanding that's really hard for a lot of people. Just grocery prices alone are crushing people. Fuel prices, energy prices, rent. It's really hard. So if you're in that position, here's what I would tell you. Do everything you can to put $10 a week aside and stack sats. And just every week, buy $10 of Bitcoin and do that for a few years. And financially, you will almost certainly be in a better position. And just do it a little bit at a time if you can, and try to do it consistently. See if you can save $10 a week. If you can get there, great. And I understand that for some people, even that $10 a week is too much. That just, you need to be able to set aside something to invest if you want to have a better outcome. And I get that it's hard for some people.
Yeah, Bitcoin is uniquely suited to meet the needs of virtually any type of person or institution, Gary, because as you mentioned, it's something that could be fractionalized unlike any other asset, and it allows for access unlike any other type of monetary technology. And it is fascinating, in my opinion, that you could speak to someone who may only be able to put $10 aside each week, and year over year, 5, 10, 20 years down the road, they'll be able to actually grow whatever wealth they have at a rate they otherwise wouldn't have been able to. But it's also interesting to me that Bitcoin is now like packing a punch all the way to the largest institutions in global financial markets as well. And it does everything in between. Like just, I want to say last week, it was BlackRock, right? That them and everyone else who's sponsored an ETF in the US this year has been wildly successful. And and BlackRock, I think it was last week or it might have been this week. There's always a lot going on. They released a report. It was Bitcoin as a unique diversifier. And it's just remarkable to me that you have something that is so groundbreaking as a technology and as a way that both individuals from the very bottom of the totem pole could use this to better their lives in the same way that someone who's allocating hundreds of billions of dollars on behalf of pensions, right, could use Bitcoin to offset some of their exposure to depreciating U.S. treasuries in real terms. And I just think that's so unique. Then it's nothing that we've ever seen before. And I just can't believe that, like, in a 15-year period, right, we're almost at October 31st, about a month away, white paper day. You've gone from a mailing list of cryptographers to $10.6 trillion asset manager publishing a report about why people should consider this in their investment portfolios, from the smallest fish to the largest pool of capital.
I think about it this way. Imagine you were running a giant pension fund, right? And so you had a very long duration and you had to provide for people in their retirement, and that's your goal. Why wouldn't you have a 1% position in Bitcoin? Right? I mean, these guys, they're all busy with their 60-40 allocation, which doesn't work anymore. And, even if you make nominal profits on the bond side of that, you're not making real profits, right? Like, whatever money that you're saving for your people in that bond portfolio, the purchasing power they're going to receive is less. It's the opposite problem of the problem my bank has when they wrote me that mortgage, right? I'm writing the same check for 30 years. Well, but what, if you own my paper, what can you buy with that? Well, the government bonds are the exact opposite problem of that. And so, putting 40% of the portfolio in something that loses value over time. And they can say, no, we have more dollars. But what can you buy with those dollars? And so, if I were managing $1 trillion portfolio and I had to think about the welfare of the people under my financial care for the next 30, 40, 50 years, like, why wouldn't you have at least 1% of that portfolio? You can't carve off, 2.5% of your bond portfolio and put it in Bitcoin. I certainly would.
Does your Bitcoin custody setup keep you up at night? Maybe you still have coins sitting on an exchange worried about hackers. Or maybe you've set up your own self-custody but don't feel safe with your Bitcoin savings stashed on a little plastic device in your desk drawer. Gain peace of mind with Onramp and our multi-institution custody solution. Here's how it works. Onramp creates a dedicated multi-sig vault just for you. 3 separate institutions each hold a key: Onramp, BitGo, and CoinCover. But none can move funds unilaterally. Instead, only you have control over your coins. With Onramp's multi-institution custody, you'll sleep better at night knowing your Bitcoin is stored with best-in-class security on-chain with fault-tolerant multi-sig. If you believe your Bitcoin is going to be worth a lot someday, don't jeopardize that future by exposing your coins to hackers on exchanges, $5 wrench attacks in the real world, or perhaps most importantly, the risk that you might screw something up with a highly technical self-custody setup. Onramp's multi-institution custody eliminates single points of failure, reduces your personal attack surface and technical burden, and provides access to financial services that allow you to confidently secure your Bitcoin, including inheritance planning, insurance-backed warranties for all balances and transactions, low-cost trading, and more. Bitcoin is a once-in-a-species asset. Secure it right. Learn more at onrampbitcoin.com.
Totally. Yeah, it's interesting, right? Because Jesse's point earlier and your point, Gary, now really mesh together well. Because if you are someone starting your career, Bitcoin offers you long-term growth potential that other asset classes likely will not be able to match. And in the same vein, you have this retirement age populace. It's a massive demographic, right? Boomers own, I think, $70 trillion of wealth. And then you have people who are nearing retirement age, and they're grappling with the fact that their purchasing power is declining at a faster rate year over year in bonds today than it was 10 years ago, just because of the fiscal situation that we talked a little bit about. And that's really, it just goes to show the flexibility of Bitcoin in a portfolio. I think the optimal place to start for most people, if they have a traditional allocation, is somewhere around 3 to 5%. And then, of course, it is a nuanced topic, and you have to consider one's unique financial circumstances and family circumstances, whatever it may be, to determine what the right allocation is for you. But it does play a really critical role. And I feel like one thing I did want to touch on, Gary, that we didn't get to yet is the chart that you threw together on inflation. I think it ties into this, right? Because we just went through a very large run of inflation in the past 4 years, and some may think that the mission has been accomplished. We're back to around 2%. We already talked about some of the issues with measuring CPI, but you threw a chart together. I'll pull it up on the screen that shows the kind of the double peak of inflation. It was comparing some period in the 1960s to the 80s versus, I think, 2013 to 2024, where we are today, and then kind of looking forward. So could you offer some thoughts going forward, your macro thesis, how you're thinking about inflation? Because I would, me personally, I'd get a lot of value out of that, and I assume our listeners would as well.
I think to answer that, it's important to go back and talk a little bit about economic history, which I know is a fascinating topic for everybody. Everyone loves it as much as I do. But before I do that, I just want to, give proper credit. We did put that chart together, but I'm not the first person to come up with that relationship or this particular presentation. I know other people have done this. In particular, I want to credit the Kobayashi letter. They have a chart, very similar to this. They did it before we did, but they hadn't updated it. We needed an updated version, so we just produced it. But I just want to be clear, there were other people doing this kind of analysis before me, and it's really important to credit them and to not claim, intellectual credit for someone else's idea. More importantly, let's talk about the history here. So when we think about huge periods of horrible inflation in the US, everybody, my age, the example is the late 70s, when, inflation was closing in the mid-teens, closing in on 20%. And, we all know the story of how then Fed Chairman Paul Volcker raised the Fed funds rate to around 20% to get that under control. And it worked, but he had to crush the economy. Now, here's the part that a lot of people don't realize. That inflation actually started back in the 1960s, and it started to get really bad. And there's this incredible story where then Fed Chairman Arthur Burns got summoned to President Lyndon Johnson's ranch in Texas. And Johnson was a very large man and not delicate in his behavior. And the story goes that he picked up Federal Reserve Chairman Burns, slammed him into a wall, and told him, "I want lower interest rates." And of course he does, right? Every president wants lower interest rates because it stimulates the economy. You want to show good economic growth. Now, is that a good idea? No, because you end up with malinvestment and asset bubbles. But if you're in that chair for 4 or 8 years and you're going to be judged on the economy, you want low rates. And, we've seen that. And this is why every time, the party in power is always clamoring for lower rates. And, this is normal. So Burns, caved. And I can understand how it's intimidating having, a 6 foot something president of the United States slam you into a wall. But Burns caved. And he lowered the Fed funds rate too early. And, you can see on the chart, oh no, right? We ended up with this huge spike in inflation. It's, they called it this double dip situation. You can see the two huge spikes. That's the blue line on the chart. And so, take a look at where we've been over the last, 10 years or so. And, the end of that red line, that's where the Federal Reserve is cutting rates. Anyone want to guess what comes next? Because it's pretty obvious. Look at the blue line, right? That tells you what's coming next. And, I understand why Powell did this. My view is he's seeing the same thing we're seeing, which is we have a bifurcated economy. The issue, and I was right for more than 2 years, but I thought Powell would hold the line longer. I thought Powell would be more afraid of being the next Arthur Burns. And, if you're the chairman of the Federal Reserve, you can survive causing a recession. You can't survive a resurgence of inflation. And so I figured Powell would go the Volcker route and just not care if he threw us into a recession, but hold the line until he got inflation really under control. And, I think Congress forced his hand. Now, the reason we're in more trouble now than we were in the 1970s is because our debt to GDP ratio then was much, much lower. And so, again, then Federal Reserve Chairman Paul Volcker had the option to raise the Fed funds rate to around 20%. I think it maxed out at around at 18, something like that. But
18.
It was okay. So 18%. Powell doesn't have that luxury. Not with, the U.S. has $36 trillion of on-balance sheet debt. The off-balance sheet liabilities are more than 200 trillion. Again, what can't be paid won't be paid. But this is an issue. Volcker had more flexibility than Powell has, because if Powell tries to raise interest rates to forget 20% or 18%, if he tries to go to 8% or 10%, the U.S. interest expense blows out the budget. And what do? Then we print more dollars. And now we're back to the original definition of inflation, which is an increase in the money supply. It's a disaster. If you want to know where we're going, we've been saying, for 2 years now, look at Japan. Japan has this exact problem, right? The yen has plummeted over the last couple of years. Just 2 years ago, it was 102 yen to the dollar. Earlier this week, it was the low to mid 140s. Earlier this year, it was 160, 161, something like that. That's a huge problem for Japan, but their debt to GDP is even higher than ours. It's more than 260%. So if you're the Bank of Japan, how do you get rates off of zero? Right? Again, they have the same problem. No matter what the Bank of Japan does, they have a debt problem. They have an interest problem. They have a financing problem. That's the direction we're headed. And there's nothing that's going to stop that. There's nothing that's going to change it. There's nobody that we can vote for in November who has, even as part of their plans, cutting spending. And that's the thing that's necessary. So Powell has a lot less rope than Volcker did. But he caved early out of fear of causing a recession. Again, I understand his fear, but look at that blue line and let's figure out what's coming next. And I think what we're going to see over the next 2 years is a resurgence of inflation. And there are people who say, well, if the CPI goes down in the next few months, that I was wrong. This is a longer term problem, and these things act on a lag. And one of the biggest problems that we had with zero rates for so long are the zombie companies. And that's just, a fancy way of talking about when interest rates are zero, companies that should go out of business don't, and you have a misallocation of assets, right? You have money going into businesses that are failures. They're just, the reason they're called zombie corporations is they're dead. They just haven't been buried yet. They're walking around dead and they just don't realize it, or, haven't just been properly buried and discontinued.
It's funny you mentioned the zombie, because this is like super hyperbolic, but I've come to this conclusion that every company's zombie company is just at what level, because they're all built on a standard with the monetary policy not actually in congruence with like the universe. There's a cost of capital that's not actually what it was. So like you think about just all the companies that exist, you keep rates at this level or higher, who stays alive long enough? And there's very few companies that most people would expect, just because there's an artificial low. Anyway.
Yeah, in fact, I think last week it was announced that the last Kmart store in the country is closing, right? Sears imploded, Atari imploded, like all of these companies that had been around for decades eventually went to zero.
There's a great anecdote. You're probably familiar with, Gary, with pre-World War I inflation, or everything's hot. Post-World War I, there's kind of like disinflation and kind of production goes down. Ford, people are like buying less, they have debt. They basically, instead of take out loans to keep up with the rate of what they were selling cars for, they basically shut everything down. and rebuild from the ground up, and they like have to cut their costs by 20 to 30% by just going deep like into how do you actually build better, faster, more efficient, to the point of like you have to destroy some things go under while others come back stronger. And he understood that versus taking the capital. And I think this persistent zombie that you bring the cost of capital down, you extend loans, and you keep people alive longer. And it's just this persistence that's inorganic across everything.
Yeah, Michael, what you're talking about, it's not just an economic argument, it's a sunk cost argument. And that gets to people's emotions. The longer people have been involved in something, the more emotionally attached they are to it, the harder it is to just say, financially, we'd be better off tearing this down and starting over and building it from the ground up. But it's hard to do. It's hard to do it with assets, with companies. It's hard to do with personal relationships. People have, understandably, an emotional attachment to something that has been with them for a long time. And those emotions can be very difficult for people to manage. Again, one of the things that's really important in my business is being able to emotionally distance yourself from the daily performance of your portfolio, right? You have days when you're up a few percent and you're making a lot of money. Guess what? That does not, the stock market agreeing with you today does not make you a genius. And just like the converse doesn't mean you're an idiot. These decisions play out over a long period of time, and keeping yourself emotionally calm when you look at intraday trading on a daily basis is very much a challenge for people in my business. And I think the best answer, Michael, you're talking about old stories and old economic stories. One of my all-time favorites is people love to ask hedge fund managers and asset managers, what makes you sleep well at night, or what keeps you up at night? And somebody said, listen, it's not my job to sleep well. I get paid to worry about stuff. I get paid to worry about what's going to happen. I was talking to a friend of mine earlier this year. I had a unique investment opportunity, and I called a few friends, and I said to them, look, I can make room for you in this. And a bunch of them wanted to do it, and that was great. And one of my friends said to me, can we talk about this? I said, sure. He said, I just want to feel better about it. I said, stop. That is not my job. My job is not to make you feel good about this. I'm trying to make money, but our feelings about it are not relevant. Here's the analysis, but a certain amount of discomfort is going to come with the territory. You don't get these great opportunities. And bring it back to Bitcoin. It's one of the things I really admire about the hodlers. Bitcoin goes down in dollars, and they're like, we're stacking sats, right? Like, they don't get upset. They don't sell it. They don't vomit it out. Their view is, okay, well, just wait. Our job is to hold it and buy more.
Yep.
And that kind of emotional distance, that lack of emotional volatility serves the Bitcoin community well. And coming back to something I was saying before, I would love to see it more in, my part of the business, people investing in publicly traded equities.
Yeah, one thing that when you were talking about inflation earlier, and then the emotions of investors and people in general, that potential looming spike, even bigger than the one we went through over the last 4 years of potential inflation in the next half decade, that the emotions that will happen for everyone in the country and in the world will be, I think it's hard for us to properly appreciate how cataclysmic that will be, and how much that will, you talk about, decades happening in a short space of time, the kind of emotion that will cause people to question the dollar, question the status quo, move towards Bitcoin. I think that I think it's very hard for us to appreciate how much Bitcoin will move forward into the mainstream if that second spike of inflation does materialize. And it's all due to emotion and what that'll cause people to get over and cast off their prior views of Bitcoin and and their determination to stick to the 60-40 in particular. I think like the writing's on the wall. If you see that chart, and then you can imagine the emotional landscape that chart would imply is plays out.
Yeah, and Gary, would you reference a second ago about the hodler or stacking? Like when your purchasing power and your net worth goes down by 20% in a day or 40%, you can still buy more. In that is embedded that you're spending less than you make, because you have the ability, because there's different kinds of leverage. And as the price of anything appreciates, like you said, you get this psychology that you're kind of can walk on water and you start to spend more than you can. And the other side of leverage is business building. Because I've seen this, like Bitcoin's life cycles are just, if a business life cycle is 5 to 10 years, Bitcoin's life cycle is 18 to 24 months, or whatever the directional analogy would be. And so generally in Bitcoin, people on the business side tend to outpace, or they get really excited and they go higher, and they ultimately have to fire, or they go out of business because they've overextended. And so there's this natural like prudence that has to be embedded across, that is just, again, in congruence with how people should just operate, with spending less than they make, even though that price appreciates and you can step into it over time. But I think that's just a function of like a better society and civilization, if people are operating like this, who've just been operating in a different kind of climate with the cost of capital.
I completely agree with you. And it gets to that key issue that when you have inflation and people have, this very high time preference, you have no investment. People just spend. Having hard currency, or in this case, Bitcoin, which effectively is becoming a very hard currency, people have a low time preference. And all of a sudden, the idea of cutting your current spending so that you can save, but save in Bitcoin or invest in Bitcoin, gives people over time a huge amount of freedom and a much greater ability to invest and build something for themselves. But for them to get there, what they have to do is live on less than they make. And they're forced to, if you want to enjoy the benefit of that, they're forced to spend less today and invest more for the future. And you're right, it's a societal change. I think it's a better way to live than the, current consumer thing where, I still hear people talking about retail therapy. The idea that you'll be happy if you go buy things, right? Go buy things, go spend money, and you'll be happy. You'll live a good life. It's ridiculous. That doesn't make people happy, right? It's building something meaningful, is doing something, accomplishing something difficult. It's our connections to other people, or in some cases, their spiritual pursuits. Like these are the things that make people happy. And so to have that longer time frame and not be focused on how much you're spending, or rather to just be happy spending less, I think that's a great way to approach life. Jesse, I also think you made this incredible point about how inflation affects people. And, we were talking earlier about how, people who lived through the Great Depression, they experienced this trauma, and basically they had a version of PTSD, right? Post-traumatic stress disorder, that followed them through their whole lives, because in their formative years, they experienced something that was really horrible. And, we have a time machine available to us to see, to illustrate exactly what you were talking about. And that's Argentina. Right. And I've spent time there. You guys know, I spent a big part of my winter, not this last winter, the winter before, living in Buenos Aires. I was with my friend Gustavo, who's a terrific person. But the people in Argentina have spent decades living with insane inflation. And if you guys could see the effort that they spend in their daily lives trying to get out of pesos, out of Argentinian pesos, and save in anything else, it is unbelievable. There are dollar brokers wandering around Buenos Aires, literally with sacks of cash, sacks of dollars. And, I knew people like these guys, they would come with thousands of dollars and they would walk away with millions of pesos. Like they would need backpacks, they'd need duffel bags to cart all of these bills around. And like, just to give you guys an example, you don't use credit cards in Argentina. And the reason is because it converts at the official exchange rate, which has nothing to do with the real exchange rate. They call it the blue market there, which is what we call the black market here. I don't know why they call it that. And so, there's been a huge amount of inflation since. But when I was there, the largest bill in circulation was the 1,000 peso bill, which at the time was worth on the blue market approximately $2.75. So, you weren't going to pay with a credit card. So to go out for the evening just to get dinner, meet a friend for a drink, you had to be carrying stacks of these 1,000 peso bills. I mean, entire stacks of it. And there was someone I dated when I was there, this, very pretty Argentinian woman. And we were talking about the currency, and she had this tiny purse, and she had this really funny line. She said something along the lines of, oh no, this little purse is just for dollars. You can't fit pesos in here. Right? And that's how you have an inflation problem. Right? When awesome. Women have to figure out which purse they're carrying based on whether they have to pay for dinner or not. And so, she knew I was going to pick up the check for dinner, and, so she could go out with her little purse. It's crazy when you think about it. But one of the great things I saw earlier this week was an article about the way Mealy has changed the real estate market there. Because people had to rent apartments out, you had to sign a 3-year lease, but you couldn't lock in the rent for more than 6 to 12 months. So people would sign a 3-year lease without knowing in pesos what the rent would be 6 months later. This is insane. And because the rental market was so closely controlled, what people would do there, if you owned an apartment, they just wouldn't rent it out, or they'd only rent it to friends. And so Mealy, by getting rid of their version of rent control, actually lowered prices. And the reason is because all of a sudden, all of this extra inventory that had been mothballed hit the market. Right. And it's insane. Imagine buying an apartment with the intention of renting it out. You want it as a rental property, and you don't because of government policies, and you don't because you can't capture value related to inflation. It's just the people there spent decades living through their own version of economic trauma, and it affected the way they did everything. And by the time you have people walking around with sacks of cash, are we at Weimar Germany, where people would have to take a wheelbarrow of cash, midday because the price of bread was going to go up? No, it wasn't that bad. But people carrying sacks of cash around Buenos Aires is, again, indicative that they have a real problem, and the people there experience their own version of trauma related to it.
Maybe that's a great transition or thoughts on China, because we know we talked about on the notes China and stimulus, and I feel like that is the one economy that most people have different opinions on where they're at in stimulating in their current, status from the individual perspective. We talk a lot about Japan and Argentina, but curious, your thoughts on China.
So, I'm certainly not the world's foremost China expert. There are a few things that jump out at me. One is the Chinese government has a problem. And the problem when you're a one-party state, particularly when that party controls the entire economy, you can't point at anybody else, right? In our government, the Democrats can do stupid things and point to Republicans and greedy corporations and Vladimir Putin and, energy companies, and Republicans can do stupid things and they can, point at the Democrats. Everybody around here has somebody else to blame. Listen, just once I'd like to see Elizabeth Warren take responsibility for one of the things she's done. So, everybody can do stupid things here and blame it on somebody else. But in China, where you're a one-party state, things go wrong. Everybody knows who to blame. And what are you going to do if you're China? You can't, if you're the Chinese Communist Party, you can't, there's no opposition party. You can't blame anybody else. So that's an issue. They also have, I think, a real issue in that they have overinvested in real estate, and that's how people there hold their wealth. In the United States, people largely hold their wealth in stocks. In China, it's all real estate, and so people are building, and as a result, their banks are over leveraged, and they built housing that they don't need, and everything's become more expensive. And so the Chinese government a couple years ago implemented these policies to try to stop speculation in real estate. Their policy, and I'm paraphrasing it, but it was something like houses are for living in, not for investment. We don't want to support this idea that your nest egg is your home and people were buying multiple homes because that's how they would save. Better to save in Bitcoin, but in China, that's also an issue, as you guys well know. And so the recent actions that the Chinese government has taken over the past 4 days or so have actually been aimed at shoring up the property market. And it's the opposite of what they said they were going to do. I think part of it is they're trying to hold up an asset bubble, because if that asset bubble fails, like it's one thing here when, large corporations fail, the downside of it is investors are going to lose their money, bondholders are going to lose their money, and the people working for those companies are going to lose their jobs. And that's all bad. But in China, if they have their property bubble burst, that is going to affect the net worth of a huge portion of the Chinese middle class. That is just hundreds of millions of people who are going to be financially crushed. That's the thing I think they're trying to hold off. So their policy there isn't completely coherent. They're desperately trying to provide liquidity to their banks, which, anybody, who wants to point out, hey, you're poking at them for that. Yeah, I know. We have that issue here too. I'm in no way saying, our economic policies are pristine, but we're talking about China. The other thing that I've been enjoying is I've been a long-term shareholder in Las Vegas Sands. That company has been undervalued. Macau visitation last month was actually above the pre-COVID 2019 levels. So there's been this great recovery there, and people are acting like, these are still distressed assets. And the concern has been the Chinese economy. And so, I think let me just take a look, a week or so ago, that stock was trading below 38. And right now, as we're talking about, it's 48.5. That move has largely happened in the last week or so. So we've seen all this liquidity and this optimism now for the Chinese economy flowing into the gaming sector, which I've been enjoying personally and making money from it. But there is something kind of funny about, the government trying to address societal issues and the money flowing into Macau.
Yeah, Gary, on the China thing real quick, so they're extremely over leveraged as an economy as well, as you pointed out. Is it pretty clear that the two choices they face are the choices any sovereign nation would face, where they either add more and more liquidity, kind of as you mentioned, which would mean at some point devaluation of the yuan, or they just have to stomach a massive deflationary crash, and that would, as you mentioned, be catastrophic, not only to folks who participate in capital markets, but more so the middle class of China that has, most of their net worth tied in real estate markets?
I think it's hard to say. I mean, from where I'm sitting, I would expect that a deflationary crash is sort of the most likely outcome, especially since when you're a single party state, while they will be blamed, they can survive it. It's not like you can vote them out of office and get somebody else. That said, we've had this long series of insane asset bubbles here, and, we don't seem to learn. And, we just keep our Federal Reserve and Congress and our Treasury Department keep blowing up these gigantic asset bubbles. And we went from, tech stocks in the 90s to real estate, back to tech stocks, back to the everything bubble. And, the zombie companies that we were talking about, we have malinvestment here, and we're throwing money at dead assets here. And, shockingly, like if you would have said to me 10 years ago, what happens, if our debt hits $36 trillion and with off balance sheet liabilities, you have total liabilities of the US government at $250 billion, I would have said, well, somebody's got to cut spending and change the benefits we're offering. And, this isn't sustainable. And yet here we are, right? With strangely enough, equities at all-time highs, gold at all-time highs, Bitcoin just slightly off of all-time highs, but up, 55% in the year. The bond market hasn't crashed, right? The yield on the 10-year, actually, let me take a look, because it's a remarkable number. Yeah, the 10-year is yielding 3.79%. The VIX is at 15, right? Like, somehow we've done unwise thing after unwise thing after unwise thing. Again, it's a bipartisan problem. And yet, our asset markets are saying, it's all fine. Don't worry, we're all rich in dollars. So I don't know. People keep asking me, when does this bubble get popped? I'm like, as soon as the bond market decides not to take the next $1 trillion offering, to not take the next $1 trillion that Janet Yellen tries to shove down their throats. But as of today, people are still buying it.
I keep getting more and more reminded of the historical anecdotes of like war bonds and how those are presented to the public as like a patriotic thing, perhaps even a good investment. But when the subtext of any war bond is like, you are going to destroy your value if you buy and hold this. That's how the war bond helps fund the war effort, is by confiscating your value, and necessarily doing it in a way where you're not presented up front with like, if you buy this thing, you're going to donate a huge portion of your value to the government. But that's how war bonds work, and that's what bonds are right now. I mean, we're kind of in a war bond era, despite the fact that we're not in World War III. At least yet. At what point does $300 trillion of value sitting in global bonds and debt wake up to that reality?
Well, I think, Gary, curious to add to that, like, this goes back to the Zoltan piece when he left Credit Suisse about the inside-outside money and the gold move, in the sense that at a certain point, like, you can't eat the bond, right? Like, your country can't eat the bond, and we go back to stores of value and energy. You have your exports and your imports, and you ultimately need to export whatever you're storing your value in to import what you need to keep your country alive. And so this is like this gold notion of movement. And to Jesse's point, like, I think this is people waking up. It happens at a micro level where you can't eat the bond. So you gotta eat, you can't change the bond for your, I guess you can theoretically, but over time it produces less eggs to eat. And then from a country perspective, if you're holding bad debt, like your country's harmed. And at a certain point they look at you and like, what did you do? And I think this was like the Russian take, right? Where Russia has energy and they can start to export it for gold or other hard currencies because they have to import certain things. So I think we're seeing it in real time. Like, this is these moves in harder units that people are moving into.
I think those are great points. And, talking about the war bonds, that was, if you think about it, brilliant persuasion to say to people, yeah, you're going to lose value, but it's patriotic. It's a good thing to do. You're helping your country. And, remember, the people buying war bonds were largely the people relatively safe, maybe materially uncomfortable, but safe back in the US while their sons and husbands were fighting overseas. My grandfather fought through France and Germany with the 80th Airborne in World War II. And, he faced live action. He was a paratrooper. He, dropped out of, he didn't jump out of airplanes. They were part of the glider corps. So they'd be in these balsa wood with canvas gliders that were trailed behind an airplane. And then somebody would just, cut the rope, cut them loose. They would crash land. There'd be bullets going through the canvas. They crash land, and while under fire, they're trying to get the heavy artillery out of this balsa wood plane. And we got lucky. Fortunately, he came back healthy, both physically and emotionally. But, imagine facing that. Imagine doing that as a young man with, your mother and your young wife and your, 1-year-old daughter at home. That was my grandfather. And so when the entire country had their sons and husbands fighting overseas, it felt like a good thing to do. It felt like the patriot, like, this is what I can do to contribute, to sacrifice for the cause. And it was great marketing. And, the best proof that people no longer have that civic-minded feeling anymore is, on a daily basis, you guys raise your hand if you've seen people complaining on a daily basis that, people should pay more to the government. People should pay more in taxes. And who are the people complaining the most? It's super wealthy people. It's billionaires, or people in Congress worth, tens or hundreds of millions of dollars, that come out and talk about how the rest of us should all be paying more in taxes. And they hate it when you remind them, hey, guys, on your tax return, there is a box you can check to make an additional donation to the U.S. Treasury. There is no law not only is there no law preventing you from overpaying the amount that you're owed, but there is a place on your tax form that allows you to do so. So when you pay your taxes, all you have to do is check that box and say, I would like to make an additional gift to the U.S. Treasury of X dollars. Now, how many people do you guys know who have ever checked that box? Have you ever heard anybody complaining about people not paying their fair share and how we should all pay more in taxes who checked that box? Have you ever seen a really wealthy person who's complaining about our tax rates? Check that box, right? That's the difference between what people viewed as a noble cause and great persuasion, which was the war bonds, which got people, Jesse, as you said, to voluntarily give up value because they wanted to support this government endeavor and they thought it was worthwhile, and understandably so. But now, our version of war bonds is check the box. Somebody look it up. What percentage of people check that box?
It's got to be close to zero.
Very close to zero.
I'll admit I didn't even know that box existed. I'm not paying enough attention.
So I know the box exists. I pay my taxes every year. I pay the full amount that I owe. But I don't check the box. I don't send extra.
Yeah, that's fascinating. Gary, if you have just a few more minutes, want to touch on your favorite person, Elizabeth Warren, and the Silvergate Bank news. And it actually does tie into the discussion we're having about debt and war bonds and persuasion, because I see this as just a more forceful way to block the exit doors, right? And prevent people from preserving their value in something like Bitcoin. So I know we talked a little bit at the top of the show just about the interview that Marty did with Caitlin Long at Custodia, and I know that there's been a lot of research with Nick Carter as well. You sent out a tweet, I want to say today or yesterday, I don't know exactly when it was, but you shared your thoughts just on the Silvergate situation. I know you've been more than generous with your time today, and we're already over. So if you just want to share any high-level thoughts on that situation and how it kind of ties into the conversation today, that'd be interesting to hear.
Yeah, a few. First of all, huge round of applause for Marty Bent and Caitlin Long. They're both doing great work. I respect both of them and the work that they do. They're terrific. And so what we're referring to is an interview that Marty did recently with Caitlin. I had the chance to read the transcript of that. It was the link to it was posted on X. Jackson, I love the fact that you use the term block the exit, because that is what happens. Once you reach full Ponzi and you have capital flight, inevitably the doors get slammed down. And people should expect that there will be bank balance, that you won't be able to get your money out of your brokerage accounts. This talk about taxing unrealized gains is the first effort at slamming that door down and preventing assets from exiting the system. And, they can say, it's just for people worth more than $100 million. And I'm going to remind you that that the alternative minimum tax was originally designed to capture fewer than 24 wealthy families, but now it grabs millions of Americans. That limit won't stay at $100 million. It is designed to catch the middle class. And so what we're going to see over the coming decades is increasing gates, exactly as you described, preventing people from getting their assets out. And the reason Bitcoin is such a threat is because, one, it offers people the opportunity to get money out and out of the country. And, you can self-custody. And if you can remember 24 words, you can reseed your device someplace else. You can walk out. They can confiscate gold at the airport. They can find it on your person. They can find gold in your bag. But if you can store those 24 words in your head, you can transfer Bitcoin to yourself in any country in the world. The second thing is Bitcoin is a threat to any fiat currency because it denies them the opportunity of seigniorage. And that is just a fancy word for we're going to grab your value. That's how they're doing it from inflation. And so for people who, maybe don't do this for a living or find that confusing, it's very simple to explain it. Inflation robs you of the value of your money. So where does that value go? It doesn't disappear. The value goes to the government and to the banks. Right? That's the value of seigniorage. When you lose purchasing power, it doesn't disappear from the earth. It is being redistributed. And seigniorage allows them to do it very quietly, a couple percent at a time without people noticing. I call it stealth stealing, which, I think is a good term, but it's mine, so you guys can judge it. So that is why people like Elizabeth Warren and so many people in the US government are against Bitcoin. It prevents the government from slamming those gates shut. It prevents them from benefiting from seigniorage. It prevents them from trapping you in their system where you only have access to dollars that are being debased. The other thing that's happening is the government is trying to use illegal and unconstitutional methods to deny people banking services. And so we see that, if somebody has, political opinions that are deemed to be undesirable, they get unbanked. And, we saw that actually the UK did it, Canada did it, and we're starting to see that here in the US. We're also seeing efforts by the government to tell banks not to provide services to certain companies and industries operating legally and saying, yeah, but just don't provide banking services to people who provide these goods or these services. It is the financial version of what the government is doing with free speech, right? The government can infringe on our First Amendment rights, but what they do is they go to Facebook, and before Elon Musk bought Twitter and turned it into X, they would go to Twitter, they'd go to the platforms and say, we would like the following points of view to be, demonetized, or these people to be banned, or, the reach. They can say what they want, but just make sure nobody sees it, right? And these are not legal means, where the government is imposing on private businesses to pursue people who are engaging in legal speech or legal commerce. But that's what they're doing. And so, what Marty and Caitlin talked about is there are now credible allegations that the White House and Elizabeth Warren and the Federal Reserve conspired to put Silvergate Bank out of business. And the reason is Silvergate was serving a large number of crypto accounts. And, the story that we all got told is, it was a danger and the bank could go under. But in the end, the proof that that allegation was false is depositors got 100% of their money back without having to tap FDIC funds. In other words, Silvergate Bank was properly reserved. None of the depositors lost money. The FDIC funds were not tapped. The government didn't have to backstop it. This bank was killed. It didn't go out of business because of their own practices. It was put out of business by the US government because they didn't want crypto being banked. And that is a gigantic problem. And, here's the best proof of all of this. If they want to argue that it's a safety issue, that the bank didn't have the proper reserves to repay everybody, and they did. But if they want to argue it's a safety issue, then somebody tell me why they won't give a charter to fully reserved banks, only fractionally reserved banks, right? So if you lend out more than you take in, you can be deemed safe and you have to keep, 10 or 15% of your capital on hand. But that's a lot of leverage that you can employ. But a fully reserved bank, guess what that does? That's a threat to the system. Because guys, if you wanted to put money in a savings account or a checking account and just avail yourselves of basic banking services, why would you ever go to JP Morgan or Citi or Wells Fargo or any bank that's fractionally reserved and take the risk, right, that the FDIC will be there to bail you out if that over leveraged bank goes under, you wouldn't do that. You would go to the fully reserved bank where you know with 100% certainty your money is safe, that you will get it back, that you don't have to worry about a run on the bank, right? And they know that a fully reserved bank would drain funds from the fractionally reserved banks who donate to congressional races, donate to presidential races, who control the various branches of the Federal Reserve, right? They have embedded themselves in the system. And so what we're seeing here is multiple levels of corruption playing itself out, across our banking sector. And, these people are acting like, it's a reasonable thing to do, but it's not. And, Elizabeth Warren is constantly talking about how, there's fraud and theft in crypto. And, but we were talking about this before, right? Imagine that you're running a human trafficking ring, a drug ring, a terrorist group. Do you guys want to be paid in traceable Bitcoin or in untraceable $100 bills? Right? Well, we all know the answer to that. So Bitcoin is not within the purview of Elizabeth Warren, but the US dollar certainly is. My advice to her is get fraud in the US dollar under control. And once you manage to do that, then we'll listen to your views on Bitcoin. Why don't you show competence in the area that is your constitutional responsibility? And once you demonstrate, it's like we've said, you want to run a chain of restaurants, show me you can run a hot dog stand first. So, I would like to see Elizabeth Warren and, the US banking sector show that, they can eliminate fraud in the dollar. And once they do that, then I'll be interested in their view on Bitcoin and other crypto.
Mic drop. I love it. Gary, I think we should take just a clip of that video and send it in one of those video mailers to Senator Warren's office. She'd appreciate that. But I wholeheartedly agree
Liz,
with you.
I'm here every day. Reach out. I'm happy to talk to you.
Yeah. Well, Gary, we're coming up on the half hour here. Really appreciate the time. Excellent conversation. Very diverse topic set. So thanks for carving out some time to speak with us. Just want to give you a handoff before we part ways here. Where should folks get in touch with you to learn more about what you're working on?
Yeah, thanks so much, guys. Thanks for having me. For people who are interested in what we're doing, we help individuals and corporations and hedge funds, family offices get better returns in the stock market. We've done it effectively. We've had a whole bunch of stock picks up 100% or more, including Bitcoin, which is not a stock, but we've made great returns in that. Feel free to reach out at deepknowledgeinvesting.com. You can avail yourself of a free or paid subscription there. Would love to have the support of the community here. Love to help you make money. That's ultimately what we focus on every day. People who want to follow on social media, on X, it's Gary_Brode, Brode. So feel free to reach out there. My DMs are open, and I always happy to talk to people in this community.
Thanks, Gary. Pleasure speaking with you today. Appreciate the time.
Thanks guys.
Thank you, Gary.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.